This video is called Always Look at Enterprise Value and will cover the basics of enterprise value and why it is such an important concept for valuations. We explain enterprise value in simple terms and show why it gives a better sense of valuations. We then explain why it is important to ensure that the business makes a decent return on an enterprise value basis prior to analyzing equity returns. Lastly, we show why low interest rates or attractive financing can add value to the equity, but that it should be evaluated separately from enterprise value. So what is enterprise value? The simple way to think about enterprise value is that it is the value of the whole company if you want to own it free and clear of debt. The technical definition is that it is the market cap plus long-term debt minus cash. The debt will typically be at face value but could be at market value if it's traded debt. Cash should only be excess cash that is not needed to run the business on a day-to-day basis. So that's the definition: market cap plus debt minus cash. Here's a basic example. The enterprise value is the value of the whole entity regardless of the capital structure. So how much debt or equity or how that is split up is not relevant to the enterprise value. These two entities have exactly the same enterprise value even though their capital structures are different. Company A would be 400 in equity plus 300 in debt minus cash of 100, so an enterprise value of 600. And company B is the same, it's 700 minus 100, which is 600. So that's the basic idea. Ignore capital structure when thinking about enterprise value. Now let's show what the problem is when looking only at market cap and PE ratios. In other words, just return on equity as opposed to return on the whole enterprise. In this simple example, assume two rental homes for sale. They were exactly the same houses, are right next door to each other on the same street, so pretty much exactly the same investment value. House A can be purchased for a $30,000 down payment. That would be your equity or market cap equivalent of House A. On House B, there is no financing, so you would need to put down the entire purchase amount, which is $75,000. In addition, each house has $2,000 in cash sitting under the mattress that is yours to keep when you buy the house. This is excess cash because it is not needed to run the day-to-day operations of the rental investment. Now, both houses have a rental income of $12,000 per year. And if you look at House A, they get $12,000 in, they pay $3,500 out on the mortgage payment, and they are left with $8,500 cash per year. Their equity investment was $28,000 because they put down $30,000 as the down payment, but got back $2,000 from under the mattress. So $8,500 divided by $28,000, they were getting a return on their equity of 30%. House B had to put down the full $75,000 less the $2,000 cash that they got back, so they put in $73,000. Their net cash flow is $12,000 because they don't have any mortgage payments, but their return is only 16.44%. So you can see that House A at face value seems like a much better deal. They are getting a 30% return on equity versus House B getting 16%. But if you look at the purchase price of each home, House A is actually $25,000 more expensive. So that doesn't sound right. So that is the problem. If you're looking only at the equity, you may end up paying a lot more than the fair value of the home just because your return on equity is higher. So the first step is to always look at operating earnings to enterprise value. Make sure that the business provides a decent return on an unleveraged or enterprise value basis, not just because there is attractive financing in place. And you can also compare the enterprise value to comparable assets. Like in our home case, we can just compare the sale prices of each because they are exactly the same home. Now, operating earnings to enterprise value is actually a very standard metric used to price assets in the commercial real estate industry. It's called the cap rate and is the net operating income, normally abbreviated as NOI, divided by the price. So the commercial real estate industry has always looked at valuations the correct way. If we look at operating earnings to enterprise value, you can see with House A, the enterprise value would be the total purchase price of $100,000 less the cash. So the enterprise value would be $98,000 and the operating earnings would be $12,000 because we look at it before interest payments. So their operating earnings to enterprise value is 12.2%. House B is $75,000 less $2,000 and they also get $12,000 in operating income. So their operating earnings to enterprise value is 16%. Looking at it this way, House B now looks much more attractive than House A, which it is. However, if there is attractive financing in place, that may have some value, so you can't ignore or discount that completely. House A has an assumable $70,000 mortgage at 5%. The cost of borrowing at 5% is significantly less than our operating yield of 12.2%. We can significantly enhance our return on equity by assuming that loan, and that may justify paying a higher enterprise value price, but it depends on the terms of that financing. Because if it is just for 2 years, well then it's very transitory and we will have to refinance it at 12% in 2 years, so it has very little incremental value. But if it is for 30 years fixed, well then that may have some value and we would need to figure out what that incremental value is and we would add that onto the price. So that's how that all works. So we highly recommend that you stick with this 2 two-step process. Always look first at operating earnings to enterprise value or cap rate to compare assets. Then, if there is attractive financing that may have additional value, and you can decide how much to attribute to that. So in conclusion, separating out the enterprise value first prevents you from being blindsided by attractive financing which may be transitory. Enterprise value allows comparison across different assets on an apples-to-apples basis. The concept is even applicable at the macro or index level, and see our next video where we apply this method of analysis to assess how the market is currently valued. Thank you.